This is lecture 4. It's the third lecture on financial statements and transaction analysis. Now make sure that you've downloaded the T Accounts handout, which is on the online lecture resources page of the class website, because today we're going to be talking about T accounts, and it will help if you have your own blank sheet and you can work along with me. Okay, so we're going to just quickly review. Remember last time, or 2 lectures ago, we learned about the debit and credit table. So we're going to be using that again today. It's the last time I'm going to be posting it up. After that, we're going to try and remember what's going on. But of course, you can always have it available when you listen to the lectures. So let's start with a question. Okay, so Sanders Company was incorporated on December 1st. So that means that that's the day it starts and everything is 0 at that point. Okay. Now Sanders had the following transactions in the month of December. So let's start with the first one here. On December 1st, Sanders received $26,000 of cash and issued common stock to its shareholders. Okay, so there are 2 things that are involved here. We have cash and we have common stock. Now, cash is an asset, and for the company, cash is increasing. So we're going to debit cash. And then, of course, common stock is part of equity. And equity is also increasing because we didn't have common stock and now we do. So we're creating new common stock. That's going to be a credit to common stock. Okay, so we're used to doing these kinds of journal entries by now, but what is the next step? If you put this journal entry into an accounting system, what happens to it? And the answer is that it goes to the T accounts. Now, in a computer system, this would happen automatically. We're going to learn to do it manually just a couple of times so that you understand the process, because you have to understand what the computer system is doing in order to be able to understand the results. So we're going to do this manually today. All right, so what I want you to do is pull out that sheet of T accounts that you have, which is right here. So it should look like this. Now these are Sanders T accounts, and you'll notice that they're all empty because the company started December 1st and had nothing. All right, so we have all these T accounts, one for each of the accounts that Sanders is going to use. Now, back in our example here, we debited cash for $26,000 and credited common stock for $26,000. All right, so what we're going to do is we're going to take that debit to cash of $26,000 and put it in the cash T account. All right, now, what does debit mean? Right? Remember, debit means left side. So what we're going to do is we're going to take the $26,000 and we're going to put it on the left side of the cash T account. Now, you notice there's a little red 12-1 there. That is the date, right? This happened on December 1st. Okay? That red 12-1 is known as a reference. Now, right now, right, everything's kind of empty. It's not a big deal, but you can imagine by the end of the question, we're going to have a lot of numbers in the cash T account here because a lot of different transactions impact cash. And of course, in a real company, things will be even much, much busier. So let's say you come back later and you look at this 26,000 and you say, where the heck did that come from? What is it? The 12-1, the reference, helps you trace it back to the original journal entry, right? And then you say, oh, that's why we're debiting cash for 26,000. It came from there. Now, this is something, again, that would be done automatically by a computer system, right? So if you put this journal entry into an accounting system, it would automatically take that 26,000 and debit it down at cash and place in the reference, maybe even just as a hyperlink so that you could click on it and go back to the original journal entry. Okay? So You don't have to write the little 12-1 yourself, right? You don't have to write all these references, but I want you to get used to seeing them and to understanding that they're there and they allow you to trace back. So I'm going to do them just to get you used to them being there. But as far as you're concerned, if you're writing up a homework question or something, you don't have to put that in there. Okay, now we only did half the entry, right? We put the cash debit of 26,000. Next, we're going to do the common stock credit of 26,000. Now remember, common stock, it is an account here in the equity section, and it has a credit. Credit means right side. So in the common stock account, we are going to credit common stock for 26,000. And somehow I messed that up. So let's try it again. All right, we're going to credit common stock for 26,000. Okay, the thing that we just did is called posting. So posting is putting a journal entry in the T accounts. So you'll see in the homework questions, it'll say something like record the journal entries and post to the T accounts, right? Or record and post these transactions, right? Recording means writing the journal entry and posting means putting it in the T accounts. All right, let's go to our next transaction for Sanders. So on December 5th, they paid $85,000 cash and signed a $30,000 loan payable to purchase land for an office site. Okay, so a lot of different things involved here. Let's start with the obvious, easy one, cash, right? Now they paid cash. We know cash is an asset and they're paying it, so cash is credited. So we can leave a blank line for the debit. We know there's going to be a debit. There has to be a debit. But then we can credit cash, $8,500. Okay, next, they signed a loan payable. All right, well, loan payable, that's clearly debt. That's a liability. So if we look at the liabilities here, right, we now have more debt, more liabilities. So that's going to be a credit to loan payable of $30,000. All right, but clearly we need something else. There's no debit. So we have land, right? That's what they're buying. Land is an asset, right? And the land is increasing, so we're going to debit land. All right, so this is our journal entry. Now, next step, we are going to post this to the T accounts. All right, so we have a debit of $38,500 to land. So if we go to the land account, we are going to debit for $38,500. And we also have a credit to cash of $8,500. So we're going to credit cash for $8,500. And then lastly, we had a credit to loan payable of $30,000. So we're going to credit loans payable for $30,000. Okay, now you'll notice here with the cash, I put the $8,500 on the next line, like a little bit down from the $26,000. It's okay if you wanted to put it on the same line. It's also okay if you want to put it way up here or way down here. What matters is that it's on the correct side, that it's correctly on the side of debit or credit. It doesn't matter with the spacing or anything like that. Obviously, it's a little neater, right, if you leave some extra space or something, but if you need to squeeze something in, right, go ahead. Just put it in there. The important thing is that it's on the correct side, debit or credit, not which line you place it on. Okay, let's try another transaction. So if we go back up, then on December 9th, the company purchased supplies on account for $1,700. Okay, so they're purchasing supplies. Supplies are an asset. So if we're buying supplies, we have more, so we're going to debit supplies. So let's put that in. And of course, we didn't pay cash, we purchased them on account. Now, since we're going to pay for this, that's accounts payable. That is a bill, that's debt. So we're going to have liabilities and we have more debt. So accounts payable are going to be our credit. All right, so let me get that in there. And there we go. Okay, now we are going to post this to the T accounts. So first we have a debit to supplies of $1,700. So we'll go to our T accounts here and we're going to copy over $1,700 debit to supplies. And then we have a credit to accounts payable of $1,700. So we are going to credit the accounts payable T account for $1,700. All right, let's try our next transaction. On December 14th, we paid $600 on account. So this is short form, but essentially it means that we're paying off our accounts payable, right? So we're paying $600 off of our accounts payable. All right, so what's involved? Obviously accounts payable, right? That's what we're paying off. Accounts payable is a liability and we are paying it off, so we are decreasing our debt. So that's going to be our debit. And of course, what are we paying it off with, right? Well, we're going to be paying it off with cash. So cash is an asset, and since we're paying, cash is decreasing, that's going to be our credit. So let's credit cash for $600. All right, now we're going to post this to the T accounts. So we're going to debit accounts payable $600 and credit cash $600. So we are going to debit accounts payable by $600. Oops. Help if I clicked in the right place. I wanted to paste. All right, we're debiting accounts payable and we're going to credit cash. All right. Okay, so far so good. Let's keep going. Add in some new transactions. All right, on December 19th, they paid $100 for internet services during the first half of December. Okay, so let's go with the easy part. They paid $100. So what does that mean, right? Well, it means they're using cash, right? So cash is an asset, and if they're paying, cash is decreasing, cash is going to be our credit. So we'll leave an empty line for the debit, and we will credit cash. All right, so what's the debit? What else is involved? Well, they're paying for internet services. Now, internet services, right? Have they been used? Well, it was during the first half of December, and we're doing this on December 19th. So clearly the internet services have already been used. That's going to be an expense. And internet is another form of utility, just like electricity or water or gas or garbage. So this is going to be a utilities expense. Okay? Just as a hint, right? If you took a look at the expenses that are available for this particular question, right? Utilities expense is clearly where it's going to go. All right, so we have an expense. And as we remember, expenses are always increasing, so we have a debit to utilities expense. So let's put that in. All right, so we have a debit to utilities expense and a credit to cash. All right, so if we go back down to our T accounts, we are going to debit utilities expense. That will be here. And then we're going to credit cash by $100. Okay, now I've been kind of copying things over and I can do it. I know where stuff is. But when I say, hey, we're going to have a debit to utilities expense, maybe you're looking around and you're saying, hey, which one's utilities expense? And you're kind of looking through and trying to find it. All right, I'll give you a hint here. Let's look at these first accounts. We have cash, we have accounts receivable, we have supplies, we have land. What are those things? All of them are assets. After that, we have accounts payable, we have loans payable. Those are both liabilities. Okay? Then we've got common stock. That is equity. And then down here at the bottom, we have revenues and we have all of our expenses. All right, so does that order sound familiar? Right? We have our assets, our liabilities, our equity, our revenues, our expenses. Accountants really, really like this order, right? So when we are listing accounts, when we're listing anything, we really like to use that order. So typically that's what you'll see, and knowing that, it makes it easier to find things. So if you know, hey, I'm looking for land and land is an asset, you know it's toward the top of the list, right? And if you're saying, hey, I'm looking for revenues or expenses, you know they're toward the bottom of the list, and then liabilities and equity are going to be in the middle. So it helps you find stuff if you know that that's where it is. Okay, let's move back to another example. So on December 22nd, Sanders borrowed $20,000 from the bank for business use. Sanders' CEO signed a loan payable with the bank in the name of the company. All right, now hopefully after our last lecture, you're seeing something like, oh, the CEO is doing this, and you're slightly suspicious. Because last time we talked about how, if an executive or an owner of the company did something that didn't necessarily involve the company, right? That was a separate person and they could have their own personal transactions that have nothing to do with the company. So when we see, oh, the Sanders CEO is signing a loan payable, maybe that's for his own personal use. However, in this case, it is for business use. And we know that partly because it says right in the front here, it's for business use. And secondly, he's signing in the name of the company, right? Companies are legal entities and they're separate entities for accounting purpose too, but they don't have hands, right? They can't sign documents. We need somebody to represent the company in order to sign documents and make commitments and transact on behalf of the company. So that's what the CEO is doing. He's actually performing his job. He's acting on behalf of the company. So regardless, even though the CEO is involved, this is a business transaction and we are going to record it. Okay, so they borrowed $20,000 from the bank. What we call that is a loan, right? It even says it's a loan payable. So we're going to have a loan payable. which is a liability, and we have more debt. So we're going to credit or increase loans payable. Okay, so let's leave a debit line because we know there has to be a debit and put that in there. Okay, now what's the other part? It's not very specific in the question, but let's think about it. If we borrow from a bank, what do we get out of it? What do we get from taking on all that debt? Well, the big advantage is that we get cash, right? We need cash fast. We borrow it. The bank gives us the cash. That's why we take on the debt. So the other side of this is that the company is receiving cash, right? Cash is an asset. We're receiving the cash, so that is a debit. All right, so let's put this in here. So now we have a debit to cash and a credit to loan payable for $20,000. We're going to take that and we're going to put it in the T accounts. All righty. Okay, so we're going to have a debit to cash and then a credit to loan payable. Okay. Next transaction on December 29th. We're heading to the end of the month now, so our transactions are going to start winding up. On December 29th, they paid advertising expense of $1,800 and an electric bill for $1,400. All right, so advertising expense, it's right there in the question, right? We clearly have advertising expense. We have an expense, and expenses are always increasing. We have more expense, in this case, advertising expense. So we're going to debit. All right, so we are going to debit advertising expense. There. All right, and they also paid an electric bill. All right, electricity, that is utilities. And we know that utilities bill after the fact, after we've already used them. So we've already used the electricity. This is a utilities expense. And expenses are increasing, so we're going to have a debit to utilities expense. All right. Now, of course, we can't just have two debits. We need a credit of something, so there's something else involved. And that's this word here. They paid these. What do they use when they pay? Well, the default assumption is cash. If it just says paid without anything else, we assume cash. So cash is an asset, and since we're paying, cash is decreasing. So that's going to be our credit. And the amount of cash we're paying is these numbers here, right? The $1,800 and the $1,400. So that's a total of $3,200 cash. All right, now let's post that in the T accounts. So we have a debit to advertising expense of $1,800. And we also have a debit to utilities expense of $1,400. So for utilities expense, we're going to put that one in. And then lastly, we have a credit to cash of $3,200. So here in cash, we're going to have a credit of $3,200. Okay. All right, let's move to December 30th. On December 30th, they recorded service revenue earned during December. $12,000 was paid in cash and $8,000 was paid on account. Okay, so they're recording all their revenues at once. We know clearly there is service revenue. Okay? Now, $12,000 was paid in cash and $8,000 on account. All right, so if we're paying in cash, cash is an asset and we're receiving it because we're earning the money. Customers are paying us. So we're going to increase cash. All right, and the customers paid $8,000 on account. Now, since this is revenue, it's the customers who are paying, not the company. So $8,000 is paid on account by the customers. When that amount is finally actually paid in cash, the money will be coming to the company. We will be receiving it. So this is going to be accounts receivable. Okay? And accounts receivable is an asset. We now have more customers who owe us money. So we're going to debit accounts receivable. Okay. Now, all of this, we already said, is going to be service revenue. And revenues always increasing. And we can see that increasing is a credit. So we're going to credit both amounts, $20,000 to service revenue. Okay, now let's post that in the T accounts. So we have a debit of $12,000 to cash. So let's put that in the cash T account. And we have a debit of $8,000 to accounts receivable. So we'll put that in the accounts receivable T account. Oops, somehow that went on the wrong side. There we go. And we have a credit of $20,000 to service revenue. All right, so if we look at the service revenue account down here in the corner, we're going to credit $20,000. Okay, now there are two more transactions. They both happen to occur on December 31st. So here first, on December 31st, they paid employee salaries of $2,400. Okay, so they're paying employee salaries. Employees get paid after they work. So they've already worked, we've already received the benefit of their work. We've used it. That means we have an expense. So we're going to have a salary expense of $2,400. And expenses increasing, that's going to be a debit. So we're going to have debit to salary expense of $2,400. All right, now it says they paid these salaries. So if we're paying, well, we're paying in cash. So cash is an asset, cash is decreasing. So that's going to be a credit. Okay. So we're going to credit cash for $2,400. And now we'll post that to the T accounts. So we have a debit to salary expense, $2,400, and a credit to cash, $2,400. All right, so we have that debit to salary expense. And we're going to have a credit to cash of $2,400. All right, one more transaction for the year. Also on December 31st, the company declared and paid a cash dividend of $7,500. Okay, so they have dividends. Dividends, like expenses and revenues, they are increasing. We didn't have any dividends and now we do. So we're going to have a debit to dividends for $7,500. And then, of course, clearly it was paid in cash. So since we're paying the dividend, cash, which is an asset, is decreasing, and that's going to be a credit. So we're going to credit cash for $7,500. All right, and we're going to post that in the T accounts. So we're going to have a debit to dividends of $7,500. And then we're going to have a credit to cash of $7,500. Okay, so that's the end of the transactions for this company. So hopefully your T account that you have been filling in as we've been going along looks something like this. Okay? Of course, you don't have to have the references, but the black numbers in black, those you should have. Okay. Now we have all the numbers combined in their separate accounts. So we can go look at an individual account, right? It's like say cash and say, hey, here's all the activity in cash. However, just by itself, this big list of numbers is not useful. What is useful is if we add them up. So the next step to this is to add the T accounts, to total them, to get the final amounts. Now, in math, the way that we have a total is we draw a horizontal line, right? So if you have a column of numbers and you have a horizontal line underneath all those numbers, then you know that the number below that horizontal line is the total. And we do the same thing in accounting. So here, somehow I messed that up. But here with accounts receivable, we're going to, and of course that didn't copy over. So I'll tell you what I will do instead. And this is where we have technical difficulties with online. I'm just going to copy over the whole thing. And it's thinking about it, of course. Okay, so we're going to have that horizontal line which will show our totals. So in the case of accounts receivable, we're going to have, and oh my goodness. So clearly nothing's going to be working for me today. So let's try this one more time. All right, there we go. Put it on a different page. So in the case of accounts receivable, you can see we have a horizontal line here, and then underneath the total, $8,000. We had $8,000 in here, so now we have a total of $8,000. Okay. The same is true for supplies. We had $1,700 debit in there, so now our total is $1,700. Now in accounting, we call the total in the T account the balance. So we'll talk often about what is the balance in accounts receivable, right? And what that means is what's the total in that account. And that's why we call it the balance sheet, because we're showing the totals in those T accounts, the balances in those T accounts on our financial statement. So you'll often hear accountants talking about what's the balance in this account, what's the balance in cash, what's the balance in revenues. Balance means the total. So we have a balance of $8,000 in accounts receivable and a balance of $1,700 in supplies. Okay. For land, we have a balance of $38,500 debit, right? Often we like to hear that debit or credit because, of course, it makes a difference. Okay. Let's see a couple other easy ones. Clearly here we have a balance or a total of $26,000 credit in common stock, and we have a balance of $7,500 debit in dividends. We have a balance of $20,000 credit in service revenue, a balance of $1,800 debit in advertising expense, and a balance of $2,400 debit in salary expense. Now, what if we have two numbers, right? Not just one. So let's look at utilities expense here. We had a debit of $100 and a debit of $1,400. So that means our total, our balance, is debit of $1,500. Okay? For loans payable, we had a credit of $30,000 and a credit of $20,000, which gives us a balance credit of $50,000. Now, what if the numbers are on different sides? So here in accounts payable, we have a debit of $1,700 and a credit of, let's put that backwards. We have a debit of $1,600 and a credit of $1,700. All right, so what happens when debits and credits meet up? Well, they're opposites, right? One's increase, one's decrease. So if they meet up, they cancel out. So what we have here as the balance in accounts payable is the difference between these two numbers. So the difference between 1,700 and 600 is 1,100. And we know it's on the credit side because the credit was the bigger number, right? So it balances out, there's more credit left. We have a credit balance, a credit total of 1,100 in accounts payable. All right, so the only one I haven't discussed is cash. Okay, that's because cash has a lot of stuff in it. But the technique to add up the cash account is exactly the same as what we used here in accounts payable and what we did in loans payable and utilities expense. We're going to add up the numbers on the same side and then take the difference with the total of the numbers on the other side. So for cash, what we're going to do is we're going to take 26,000 plus 20,000 plus 12,000, add those up, and then we're going to subtract everything on the other side. 8,500, 600, 100, 3,200, 2,400, and 7,500. So we're going to add all these numbers and then subtract all of these. And that total will get us to $35,700 debit. Now, how did I know the total was going to be on the debit side? Well, I eyeballed it, right? Clearly, even though there are fewer, these are the bigger numbers. The total is going to be down here. There is another way I knew, which I will mention in a few minutes. Okay? And I'll teach that to you so you'll know in advance which side the total will be on as well, even if it's just a weird column of numbers. Okay, so that's how we take transactions, post them to T accounts, and then add them up and get the balances at the end. Okay, so let's say that you were running a real business. And you are not the accountant, but you need the accounting information to make decisions to run your business, right? So you may say, hey, how much cash do we have right now? Because I want to spend some money on something. How much do we have in debt right now? I need to know what we've got to pay off, right? How much have we earned in revenues so far this year, right? These are the kinds of things you need to know just to run your business, even if you're not an accountant. So if you need that information, you can always come and look at the T accounts. But believe it or not, the T accounts can be very intimidating to non-accountants. Right? A lot of people will look at a bunch of T accounts like this and they'll see all these numbers and they'll say, what the heck is this? I don't understand it. So we have another document that we use in accounting to list out the accounts and show what's in them. And this is something called a trial balance. And we're going to set one up here for this company. So we have Sanders Corporation. We're going to create a trial balance. And we're doing so on December 31st because that's the last day of all our transactions, right? Our transactions finished up on December 31st. Now, even though this happens to be December 31st, the trial balance can be prepared on any day. This is not a financial statement. This is a utility document. This is something that is created pretty much every day in a company so that people who are not accountants can look at it and know what the numbers are so that they can then use that information to do their jobs. Now, in a computer system, you could just push a button and the computer system would prepare this for you. So people are going to be looking at this every day. So this is not a formal financial statement, it's just a utility document listing out the accounts. So what we're going to do is we're going to list all of the accounts and whether or not they have a debit or credit balance. Okay. So let's prepare this for Sanders Corporation. So if we go look up here on the T accounts, we know that cash has a debit balance of $35,700. So we're going to put that here on our trial balance. Okay, now, why did I list cash first? Excuse me. Why did I list cash first? Well, remember I said when accountants list things, we like to have a certain order. So we're going to use the order that's familiar to us. So we're going to go with assets first, then liabilities, then equity, then revenues and expenses. And conveniently, the T accounts are already laid out in that order. So we're just going to follow an order and use the same order that accountants like. Okay, so the next account we're going to look at is accounts receivable. That has a debit of $8,000. And next we have supplies with a debit of $1,700. All right. And then we have land with a debit of $38,500. Okay, next down here we have accounts payable with a credit balance of $1,100. And then loans payable with a credit balance of $50,000. And common stock with a credit balance of $26,000. And dividends with a debit balance of $7,500. And then service revenue has a credit balance of $20,000. Utilities expense has a debit balance of $1,500. Advertising expense has a debit balance of $1,800. And salary expense has a debit balance of $2,400. Okay, now let's just take a look at these for a moment here. The first four accounts, cash, accounts receivable, supplies, land, right? These are all assets. But what else do they have in common? They all have debit balances, debit totals. Accounts payable, loans payable, those are liabilities. And they also have credit balances. Common stock is an equity account, and that has a credit balance. Service revenue has a credit balance. And the three expenses, they all have debit balances, and the dividends also has a debit balance. All right, does that sound familiar? Assets, debits, liabilities, credits, equity, credit, revenue, credit, expenses, and dividends, debit. Yep, hopefully you think that's familiar and you remember it's this, right? In accounting, accounts generally have positive balances, positive totals. It is possible, but we very rarely have negative amounts in the accounts. So we have a positive amount of cash, but we also have a positive amount of debt. We have a positive amount of stock, a positive amount of revenues, a positive amount of expenses. Right? So these things do not all work in the same direction. That's what the debits and credits represent. But they all have positive totals. In other words, more increases than decreases. So when you're looking at an account, you can expect that the total, the balance, will be on the side of increase. So remember back here with cash, and I said, how did I know the total was going to be debit? Well, I could eyeball the numbers. Even outside of eyeballing the numbers, cash is an asset. And because it's an asset, I know it increases with the debit, and therefore its total, its balance, should be on the debit side. Okay? So even without being told anything else, you always know that an account has a balance, a total, on the side of increase, right? Which for assets, for cash, is a debit. Okay. All right, now we're almost done with the trial balance here. There is one more thing that needs to be done, and that is that we need to total the two columns, right? So if I total the credit side, right, I have 20,000 plus 26 is 46, plus 50, right, that's going to be 96, plus 1,100 is going to be 97,100. So my total for the credit side is going to be 97,100. What do you think the total is going to be for the debit side? It's going to be exactly the same thing. Both sides are going to total to 97,100. All right, and okay, so both sides are going to total here to 97,100. Why are both sides totaling to the same number? Well, the answer is because there are equal debits and credits. And how do we know that there are equal debits and credits? Well, because way back here when we did our journal entries, every single journal entry had an equal amount of debits and credits. And then when we copied those over, when we posted into the T accounts, we had an equal amount of debits and credits. Even though they were in different accounts, overall, there was still an equal amount of debits and credits being copied. So even though we've rearranged everything now, we still have an equal amount of debits and credits. And this is what kind of gives you some feeling, some good feeling that you didn't make a mistake, right? That we have copied everything over correctly and we have the same amount of debits and credits. So that's just the balance to show you that everything is working. Okay, so to repeat one more time, the trial balance here is not a financial statement. This is just a utility kind of document or a chart. And it's something that people who work at the company will look at every single day to know what they've got. So if I said, hey, how much cash does Sanders have right now? Well, they've got $35,700 of cash. And if I wanted to know, hey, how much do they have in debt, right? Well, then I would say, well, they have loans of $50,000 and small bills, accounts payable of $1,100, right? How much revenue have they earned so far this year? Well, it's $20,000, right? So I can use that information now to run the business, right? So every day a company is going to look at the newest version of this with all the latest journal entries included, and they'll get updated numbers and use this every day. Okay, so not a financial statement, but this is a more practical document used in real companies. Okay, now that we're done with that, there are a couple more smaller topics that I would like to discuss today. So first, I'd like to talk about supplies, which has two P's. Okay, so we've talked about supplies before, And we've said that supplies are things that we use up in order to run our business. So previously I used the example with the company that paints houses, and I said paint is their supply, and then after they painted the house, then the supplies are gone, right? Because the paint is gone from the can. All right, so let's talk about how supplies work, right? Most companies, their supplies are probably things like office supplies, right? So for example, when I'm teaching on campus, right, in the accounting and finance department office, there is a supply cabinet. And it's really more of like a very big closet. It goes floor to ceiling. And at the beginning of the semester, they fill that up with supplies. So it has whiteboard markers, and it has pads of paper and pens and, you know, highlighters and sticky notes and staples, all the kinds of office supplies that the faculty are going to need. Now, they fill it up, but when I need something, I don't have to go through any fancy process. I just go to the cabinet and I take what I need, right? There's no forms to fill out. There's no security camera following my every move. It's an honor system. So I take the supplies I need when I need them, and nobody is tracking it. Now, at the end of the semester, right, they'll go look, and the cabinet that was full at the beginning of the semester is now going to have very little left. Let's say there's only one pad of paper and one marker left. And they say, hey, what happened to the rest of it? Well, it got taken by faculty and got used, right? So they had so much at the beginning of the semester, and at the end of the semester, they have a small amount left. The difference is what was taken and what was used. And of course, as we know, in accounting, when things get used, we call that an expense. So the amount that got used will be called supplies expense. So essentially, we have a formula to calculate this. So the supplies expense, or the supplies used, right, is the beginning supplies, so what we started with at the beginning, plus anything we purchased, right, to supplement. So we take all those supplies that we had, the beginning amount plus our purchases, and we take the difference compared to the ending supplies. So the beginning of the semester and everything they purchased, we take all that and compare against what's left at the end. And the difference between what we had and what's left is what we used, the expense. Okay. All right, so let's take a look at an example. Johnny Company began the year with $200 of supplies. During the year, $500 of supplies were purchased for cash. At the end of the year, there were $150 worth of supplies remaining. Okay, so we're going to give Johnny's journal entries related to supplies for the year. Okay, so there are only two things that happen with supplies in the year. We can see this here in the formula. We know that supplies are purchased, and we know that supplies are used. Right? The beginning and the ending amounts, those are just the balances, the totals. The activity, the things that actually happen, is that we buy supplies and we use supplies. So there are only going to be two journal entries to give for the year related to supplies, the purchases and the use. Okay, now the purchases, we've done that before. In fact, we had one, well, way back here in this particular question, we had a purchase of supplies, right? So we already know how supplies purchases work. But let's do it again for Johnny. And oh, I went too far. Okay, do it for Johnny. So it says during the year, $500 of supplies were purchased for cash. So that means we're going to increase supplies, which is a debit, and decrease cash, which is a credit. So here we have our purchases of supplies. Now, the other thing that happens in the year is that we use the supplies. Typically, we don't record the usage until the end of the year. And the reason for that is because we need the ending amount, right? We need to know how much is left at the end of the year so that we can then calculate how much got used. Okay? So that's what we're going to do here for Johnny. Okay, so the beginning supplies in the year were $200. During the year, $500 were purchased. So the purchases here are $500. And at the end of the year, there were $150 worth of supplies remaining. So our ending supplies are going to be $150. All right, so if we combine all this together, we get that our supplies expense is $550. And now we have to record that in a journal entry. All right, so supplies expense. We've never talked about supplies expense before right now, but it is an expense, and expenses are always increasing, which means the expense is going to be debited. We are always going to be debiting those expenses. All right, so we've recorded that. Now, what's the credit? What else is involved? Well, when we use up supplies, right, we now have an expense, but what else happens? Well, the supplies go away, right? So the guy who's painting houses, he has a full can of paint. As he uses the paint, right, he has an expense because he's using it up, but at the same time, the paint in the can goes down and eventually goes away. So we are decreasing supplies. That's our credit. And somehow, there we go. Okay, so let's summarize. Supplies increase when they are purchased, but they decrease when they are used. Right? So those are the two things that happen with supplies each year. We buy them and supplies go up, and then we use them and supplies go down. All right, let's try another example just to bring home this concept. Okay, so let's say we have a company here. Beginning supplies were $100, ending supplies were $200, and supplies expense for the year was $800. What were the supplies purchases? Well, we can take our formula and fill in the numbers, right? So we know that the beginning supplies are $100, the ending supplies are $200, and the supplies expense is $800. So we can then do our algebra, solve for the missing number. The purchases must be $900. Let's try another one. So for B, beginning supplies were $500, ending supplies were $300, and the purchases were $600. So what's the supplies expense? All right, so put that in. All right, we know the beginning supplies are $500, the ending supplies are $300, and the purchases are $600. So that means our expense has to be $800. All right, C. Beginning supplies were $1,000. Supplies purchases for the year were $800 in cash and $600 on account. Supplies on hand at year end were $1,300. So what was the supplies expense for the year? Okay, so here, right, we have something a little different, right? The beginning supplies, that's easy, right? What about these purchases for the year? Right? We have $800 in cash and $600 on account. So how much am I going to use for purchases in my equation? Am I going to use 800 or 600 or what? I'm actually going to use both of them, right? So some were in cash and some were on account, but both of them were supplies purchases. So it doesn't matter how I purchased. What matters is that the total purchases were 800 and 600. So I'm going to use both numbers. The other weird thing here is this term supplies on hand at year end. What does that mean? Okay. Well, when we say something on hand, we're literally talking about what is here that I can put my hand on. What is the physical amount right now, right? So the supplies on hand at year end, right? That's how much did we actually have at year end. So that means this is fancy terminology for the ending supplies, right? So let's just write that down so we don't forget. Okay, so that's just terminology that they often use in business. They say, you know, what's the amount on hand? That means what's the total right now? So if we say that a supply is on hand at year end, that means at the end of the year. So what are the ending supplies? Okay. All right, now that we've translated the question, we can fill in the amounts in the formula. All right, so we know that the beginning supplies were 1,000. The purchases were 800 in cash plus 600 on account. Right? And then the ending supplies, the supplies on hand, were $1,300. Okay. And so that means that our supplies expense has to be $1,100. Okay, let's keep going here. D. For situation C, we're going to journalize all supply purchases for the year in one entry. All right, so what do we have? We purchased supplies. So supplies are an asset. That means supplies are increasing. And that means we're going to debit supplies. All right. All right, now, how did we purchase those supplies? Well, we purchased $800 in cash. So that means we're paying $800 cash. Cash is going to be credited for $800. We also purchased $600 on account. That means we're using accounts payable. So we're going to credit accounts payable by $600. Okay, so both of these things are supplies purchases. They're both increasing supplies. So that means supplies is increased by a total of $1,400. That's why we used both of these amounts, the $1,400 here, as supplies purchases, because regardless of how you paid for it, the supplies increased when we purchased. All right, and then lastly here, for the same situation C, we're going to give the journal entry to record supplies expense for the year. Okay, so we calculated the supplies expense as $1,100. So we know we're going to debit supplies expense. Remember, expenses are always increasing. They're always going to be debits, $1,100. Okay. Now, as we use those supplies, the supplies asset goes down. So we're going to credit or decrease supplies. Okay. All right, so for homework from this lecture, I have from different chapters here. So from chapter 1, I'd like you to finish chapter 1 and look at questions 9 and 10. And then from chapter 2, you can look at question 5. This is on supplies. So next lecture, we're going to be moving into some other things, and supplies are kind of the tip of the iceberg, and we're going to be talking about Chapter 2 next time. So until then, I hope everything goes well and you can take a look at these things, get your homework done. And I will talk to you next time.